Hi everyone, and welcome to Coller Capital's Private Capital Secondary Market Update. Firstly, let me introduce myself. My name is Stephen Ziff, and I'm a partner at Coller Capital, as well as being the firm's head of investor relations. For this update, I'll be joined by three of my partners, discussing the key trends and outlook shaping the private capital secondary market. Katrina Liao and Yonatan Puterman, whose focus is on the private equity part of the market, and Ed Goldstein, CIO of our credit business, Coller Credit Secondaries. Thank you all for joining me today. Now, volume in the secondary market has been pretty resilient against a fairly challenging market conditions. There was in excess of $100 billion worth of transactions closed in 2022, making it the second busiest year on record. Now, as we progress through 2023, we thought now was an opportune moment to share our thoughts on the key trends as well as the outlook for our marketplace. Today, we're going to cover global trends in the private capital secondary market, the outlook for LP-led and GP-led secondaries, followed by a focus on private credit secondaries with Ed. We're going to cover a broad range of topics, so let's get started. I want to come to you, Katrina, first of all, and let's start with market volumes for 2022. By any stretch of the imagination, it was an unusual year. Can you talk us through how the year evolved and some of the factors that were at play?
Q1 started very strongly on the back of 2021. A lot of the transactions that were in the market Q4 of 2021 closed during Q1. So that added to the transaction volume, plus the strong start of the year. Then with the market volatility, I would say a lot of sellers pulled transactions Q2, Q3, but the ones that remained in the market definitely got repriced. Coming into Q4, you did see a pickup of transactions, mostly on the LP-led side, because LPs were still over-allocated private equity and still needed to find solutions for their portfolio. GPs, on the other hand, held fire. They wanted to see how their underlying companies performed during the year.
So I would almost say strong Q1, slight hiatus in 2 and 3, pick up in Q4 as those that really had to transact.
Exactly, which all still contributed to the $105 billion.
Still a strong year, as we've said. Now, as we come into 2023 and we're almost at the end of the first quarter, Yonatan, what are you seeing already in this year, and are some of those trends continuing? What's at play in the current marketplace?
So yes, 2023 will most likely see an increase in deal activity, especially after 2022 at $105 billion. There is a lot of pent-up supply in the market, on the sideline, waiting to come to market. So that's something we see already, especially if the public markets stabilize and a soft landing is achieved. The current kind of ratio in the market, dry powder to deal volume, is at the 1.2 times, which is an attractive ratio for the buyers. So an interesting year ahead.
Okay. And Ed, we've had the view from the equity side, from the credit side. 2022, was that the breakout year for secondary credit?
I mean, it was a great year. So if you think about the $105 billion, right, it was a very strong number, although slightly down from the prior year. Credit continued on its growth trajectory. So, over 17 billion of transactions, which is a record number, and was up double digits from 2021. So when you say breakout, I would say it's continuing to break out, and we're optimistic that those numbers will be even higher going forward. The dry powder ratio Yonatan referred to, in credit, it's even lower. It's below a 1x. So we see just continued momentum in that market.
Great. And now let's dive into different parts of the market. I want to focus, first of all, on LP-led secondaries. And Katrina, I'm going to turn to you. Talk us through some of the factors that were at play, in terms of allocations, liquidity, what was going on throughout each of those quarters.
Sure. Well, entering into 2022, LPs were still over-allocated to private assets. The market volatility didn't help. It just made their portfolios look even more imbalanced. So you had an over-allocation problem that the LPs were experiencing and had been experiencing, but also a liquidity issue, as these weren't the right market conditions for GPs to exit their assets. So GPs that were planning to exit assets all of a sudden had to hold on to them for a bit longer. So you're seeing a lack of distributions coming out of funds that they're invested in, but you're also seeing GPs coming to market at record paces. I think Preqin says it's a 3-year cycle now where GPs come out to market with their next fund. So you've got their GPs that they want to maintain relationships with coming out for additional commitments, plus an over-allocation to the asset class, causing this dynamic of LP-led transaction flow.
And obviously, further exacerbated, as you've said, by, a shortage of liquidity
Yes.
as well.
Yeah.
Now, what about, Yonatan, I want to come to you, valuations.
Yeah.
Now, what part did they play throughout 2022? And
Yeah, so look, the valuation gap as being a big theme, the bid-ask spread, delaying some of the transactions, and it's really a function of the stickiness of the private company's valuation on the back of markups in recent years. But on the other side, we are seeing discounts widening and willingness to sell, and increased willingness to sell by sellers. So I would say that overall, the pricing right now on the LP-led deals is reasonable to attractive.
okay. And I'm going to shift now to the other part of the market, the GP-led part of the market. Katrina, back with you. GP-led, close to 50% of the market in 2022. To what extent are those types of transaction impacted? Is it the same factors at play? What's influencing the outcome on those opportunities?
They are similar dynamics going on in the GP-led market as LP-led. GPs, ideally, they would have explored sales of their assets, but the IPO markets, the M&A markets at the time, or during this last year and this year, are a bit challenging. So a continuation vehicle and going into the secondaries, GP-led continuation vehicle market was an option for them to explore on their assets. So you've got GPs needing liquidity, needing to exit some assets, but also they're getting push from their LPs. LPs were also wanting liquidities in the funds that they were invested in. And it felt like more LPs were more on board with GPs exploring continuation vehicles. So that also pushed the GPs to look into the GP-led market more.
Now, clearly they're driving for liquidity, but it seems sort of quite ironic that they're often looking for liquidity on some of their better assets. So, Yonatan, what's that all about? What's the dynamic there?
Yeah, an interesting dynamic. The GP-led, single asset GP-led transactions accounted for half of the market, more or less. And we think this trend will continue as more and more GPs are realizing that there is a lot of value in holding onto their trophy assets, clipping more value rather than selling it to another party, especially when the IPO market is closed. This trend started or continued in 2018 onwards. We don't see a change, so better quality. And on the buyer side, some investors invested in single assets with big exposure. We think that going forward, the selectivity will be even higher.
Now, Ed, I'm going to come to you now because we're going to pivot towards credit. Because we discussed in our last webinar the rise of the secondary credit market. The market conditions that Yonatan and Katrina have spoken about and that we've seen, do they lend themselves well to credit secondaries? How does that dynamic play out?
Yeah, so it's interesting. The sellers are often the same, right? So if you're an LP that needs liquidity or is looking to rebalance, you'll have a private equity book and maybe a private credit book managed by the same team. And so when it comes to having the conversation about you getting liquidity and discount you might need to take, there was an interesting shift in dynamic last year. And the reason for that is, if you think about in the credit secondary space, the cost of capital, it's a little bit lower. So now that you've got dedicated capital for private credit that can price deals at lower returns, it makes it more interesting for a seller to weigh what should I sell. And in a year like 2022, when you had equity valuations in the public market declining and potentially very large discounts for LP books on the equity side, we'd see this shift in dynamic where if you're a seller, you say, okay, well, I could take X discount on my private equity book or Y on private credit. That private credit discount relative to private equity shrank. And so it gave sellers another option to say, well, I'm going to sell my credit book instead. So over the course of last year, we saw that dynamic changing, and it made it more interesting for people like us who are buying credit to say we can get not only wider discounts, but under the umbrella of very big discounts for equity, but you combine those discounts with the fact that we're buying floating rate product and base rates increasing. So those two things in combination actually increase the return profile for credit secondaries So it was a very attractive time for both buyers and, in a sense, sellers, because they could sell something at a price that they might have gotten, something a lower bid a year ago.
And effectively, if you had an investor that had effectively allocated to both asset classes, gave them some optionality to look at either or both. Did you see many investors transact on both parts of their portfolio?
So yes and yes. In fact, there were situations where we provided to a seller solution for equity and credit, and they said, "Well, actually, we'll choose this."
Yep.
And we were the only one able to do that. So it just they appreciated having that optionality. And then another situation where they decided to sell both. So having that flexibility was pretty critical for those sellers.
Okay. And if we look specifically within credit, because obviously alongside equity, it gives that flexibility on both sides, but specifically within credit, as that market grows, what sort of other strategies can we expect to see in this marketplace?
Yes. So if you think about private credit as a whole, it's the way we define it, it's a $3 trillion-ish market. The biggest segment of that is senior direct lending. So that's the biggest driver of volumes today. But that's only about 60 to 65% of the market. So as the primary market grows, and then by its derivative nature, the secondary market, other strategies like mezzanine, distressed, those will become big enough where the ability to specialize in sub-strategies you'll see that start to take place. And you've seen a little bit of that already. And on top of that, you've got the fund lending market, which is also an adjacency to the private credit secondaries market, which is also growing pretty rapidly. So I think you'll see the growth of 4 or 5 different subcategories over the next several years in credit secondaries.
Okay. Certainly an exciting time to be in credit secondaries for sure.
No doubt.
And as we continue to look forward, and if we focus on predictions, Yonatan, I want to get you to look in your sort of crystal ball to begin with. We've talked about other strategies within credit, but beyond credit, equity, credit. Where next? Where's the market going?
You say beyond credit, but I do think credit is probably the big next thing. But we've seen real asset being a big part of the market. So infrastructure and real estate, and with elevated interest rates, I expect it to be a big part of the market going forward.
And Katrina, you and your crystal ball now. I mean, we're seeing new investors come into the marketplace all the time. We've just launched our own private wealth secondary solutions business. For you, what does this mean for the long-term growth of the market, and your thoughts around that?
Sure. Well, first off, I would say, secondaries is a natural investing pot for high net worth. If you're going to get into private assets, secondaries is highly diversified in terms of company exposure, sectors, geography, vintages, managers. And I think if you look across the over 30 years since secondaries has been in existence, no fund has been below cost, or I think less than 1% has returned below cost, right? So in terms of the platform and our evolution, beyond just looking at other asset classes, such as credit, it makes perfect sense for us to also expand into other investor bases.
Okay. So natural evolution.
Natural evolution.
Okay. I'm going to try and sort of pull it all together and open it to the three of you. I mean, we've covered a lot of ground in terms of a little bit looking back, looking forward, different asset classes, different pools of capital. What's your longer term prediction around the marketplace? So not just 2023, but beyond. What's your positive, hopefully, prognosis on the market?
I'm happy to go first. So
yeah.
To talk about more than credit, I mean, well, if you think about the evolution of the industry, there's always something new, right? Some new technology, new invention. 10, 15 years ago, it was the bank selling, right? Then there was, okay, what's next? The rise of GP-leds, which had been in existence, but really accelerated over the last 3 to 4 years, then the rise of single asset GP-led. So easy prediction is that there's going to be some new invention, new creation that stimulates deal activity.
Sure.
And that's just on top of the regular way growth that we're going to continue to see in both the equity side and the credit side, and potentially new asset classes. So I wouldn't be surprised if you see some new type of transaction technology, something else that fits within the definition of what a secondary is. It just continues to grow the perimeter of the market.
And maybe a view on volumes looking forward, maybe out to the end of this decade. And
yeah, I think if we just look at the historical trend and we just kind of plot it going forward, it's not going to be a straight line, but we do see the deal volume on the secondary market getting into $500 billion, a number which was crazy to think about 10 years ago, but we're getting there.
Okay. And Ed, credit, I mean, starting from a slightly lower base.
Yeah, so I mean, specifically on credit, so if you think about what the annual turnover rate is in private equity today, it's around 2%-ish, maybe plus or minus. So in private credit today, it's below 1, right? So if you just do some fairly simple math and you say that the underlying primary market grows to, call it 5 trillion by the middle of the decade, which is just taking the same growth trajectory, 1% of that is 50 billion. So we can easily see a path to that over the next few years.
Very exciting. That brings us to the end of today's session. Katrina, Yonatan, and Ed, thank you for sharing your views on the market. I'm sure we'll all agree it's a fascinating time to be in secondaries, particularly as the market evolves into new strategies. We are all very excited about the growth opportunities and what lies ahead. From all of us and my partners here today with me at Coller Capital, thank you for joining us.